Welcome to the module on changing structure and role of banks. Whenever we are actually considering a financial market, banks as an essential part, and hence the concept of the banks, the evolution of the banking system, and moreover the functions of the banks for strengthening the nation and its particular potentials are to be analyzed. In this context, we begin with the concept of or the definition of a bank. So according to various school of thoughts, it means that bank is a business, the bank which can sell their services to earn money and which must earn a profit to survive. So whenever we are defining the word that the bank is a business, it mainly refers to the transactions or any kind of engagements which are done between different stakeholders of the banks, which may be the depositors, the lenders, the customers, and also in terms of various kind of linkages that the bank holds today in the digital platform, in terms of the e-banking services, or in terms of the foreign exchange transactions or any other kind of functionaries the bank does. Sell their services to earn money in the sense that there is a concept of credit creation, there is a concept of money multiplier. All these are involved in the banking functions and the services in terms of various kind of disbursements that is being done with the objective of earning income or earning money. And also in order to survive in this particular competitive structure, it's very important for a bank to earn a profit. And this basically refers to the banking health or the banking conditions. This also takes care of how the bad assets can be considered, can be optimized, and how it can go for a better survival strategy. This boils down to the discussions of the role of bank. So in any financial institution, the banks perform certain primary and secondary roles. So with reference to the role of the bank, first of all we consider the service-oriented roles of any banking institution. So when we talk about the service banks, they have to do entirely with the handling of the money for the other people. This takes care of the circulation of the money, which takes care of money as a medium of exchange, measuring the values of the goods and the services, and money which something is worth of. So in terms of the circulation of the money, in terms of the currency that is being printed by the bank, and as we know the functions of the money as it says, the currency exchange and others, all these are essential items as the banking institution goes in. Then we have the financial intermediaries that are important. By financial intermediary we mean any kind of safeguarding in terms of security, any kind of transferring among the different bank accounts, exchanging in terms of the transaction that are being done, exchange for foreign currency or lending, bank plays a very important role. So basically it is a facilitator which acts between the parties, and also it facilitates the flow of money throughout the economy. So throughout the economy, any kind of credit circulation that takes place, that also gets facilitated to the banks in terms of various kind of exchanging, transferring, and financial intermediaries that takes place. So basically when we conceptualize the bank, first of all money which is being created, that is the currency, and secondly when the bank is a financial intermediary, transferring, exchanging, facilitators all are involved for a banking structure. So that is how the role of the bank has been crucially identified. So this boils down to the question regarding what is the bank and also how the bank can act as a financial intermediary institution. So firstly, bank can sell their services to earn money. Bank must earn a profit to survive, that is basically important. Bank is also a financial intermediary because it also acts as a safeguarding or transferring or exchanging or any kind of money lending that is being done between the different stakeholders. There the bank play an important role. So this basically boils down to what are the different categorization of the banks a nation must have, and that is how we can explain the changing structure over time. So initially we start with the commercial banks, which basically deal with the public, and also it deals with the process of the credit creation as it accepts the money and thereby the credit flow that is being done. Then we have the retail banks, which look after the retail outlets and also look after various constructions that has been done in the retail markets. And then we have the central bank. This is very important because central bank is the most monitoring and the apex bank of a nation, which is the lender of the last resort in some of the cases, and it monitors and supervises the functioning of the commercial and the retail banks in place. So central bank basically looks as a safeguarding or monitoring the entire banking institution that is in place. So this basically looks into the recent policy changes that are taken up within the banking structure. So when we refer to the recent policy changes, first of all we refer to the concept of the mergers, and that is how the banking role has also been modified over time. So when we say the word merger, it means that a merger occurs when one or more banks join or acquire another bank or banks. So this is basically acquiring any kind of financial institution, any financial intermediary, when it occurs with one or more banks which are jointly involved in the process. So these mergers basically increase the dimension of the banking system, the width of the banking capital, giving them more and more resources. So it is observed that mainly a good performing bank has a tendency to merge with a low capacity bank in terms of dominance, in terms of increasing the size of the operations, and also taking care of the bad assets that have been accumulated over time. So mergers are considered to be one of the most viable options from the banking point of view. Thirdly, mergers decrease the number of banks because the quantum of the number of banks can also be tackled or can also be mitigated by more and more mergers coming up, which also created an opening for a new wave of the small local banks, because some of the local banks can come together and can form of a single unit, and that is how the mergers have come up in the banking sector as a fundamental policy making over the time. These mergers are also driven by the forces of globalization, where we find out that the private banks are also merged together, public sector banks have also come up in the merger process, and the objective is basically to improve the banking efficiency, the banking profitability, and the operational status of this system. This also boils down to the question that what are basically the mergers in the banking scenario. So firstly, a merger occurs when one or more banks join or acquire another bank or bank. So this is basically acquiring the banks, taking care of. Mergers also increase the size of the banks in terms of the operations, giving them more resources. Mergers also decrease the number of banks in terms of the numbers, because thereby the monetary system and the monetary structure can be tackled or can be supervised or monitored, and accountability is a big question. Mergers have created an opening for a new wave of small local banks. This is also very important because the new wave of small local banks in sense of the regional rural banks, in terms of giving them loans at a small interest rates, and this is very much beneficial for the farming or the agricultural sector. And that is how the new local banks have identified or has mushroomed in the process. So this basically brings down to the concept of the changing structure in terms of the mergers. The second changing structure over the banks refers to the technological innovations that has come up with the banking structure. This is one of the most prominent and one of the most pronounced after effects of globalization. So with the advent of the globalization in 1991 economic reforms, the liberalization measures were adopted in the financial sector, in the banking sector, with opening up of private banks along with the public sector banks. But more importantly, the importance of technology, the importance of digitalization, the importance of e-banking platforms, this has come up in a bigger shape in the banking industry. So in terms of the changing structure, along with the mergers, or technology has come up an integral part of today's banking system. So first of all, it has impacted on some of the major stakeholders within the banking sector. The first stakeholder refers to the bankers, and thereby the technology has made the functioning to be more smoother, to be more transparent, and more importantly user friendly. So when we talk about the terms like accounting, auditing, and examining functions, thereby different portals have been created, thereby the database management is being created, and more recently the cloud computing that has also come up under the artificial intelligence model of the banking sector, which makes the auditing, the accounting, and the supervisory functions to be more smoother. In terms of the swift transfer, in terms of the ECS, the banking transactions have become more and more streamlined, and this is the rationalization that has taken up. This is in tune with the impact on the bankers in terms of fund transfer, record keeping where the digital documents are being considered. And this takes about the digital lockers, the digital documents, where the financial analysis statements which has become instantaneous. So this is one of the most important merit or one of the most important blessings of technological innovations on the banking system, whereby the transparency is being maintained in terms of transfer of funds, in terms of record keeping, and more importantly the financial analysis which can be done. A different software has been designed, e-portals are being created, and all these e-platforms are being taken up to make the bankers more user-friendly. Secondly, the most important impact on the customer's point of view is the availability of the money in a shorter span through various kind of smooth mechanisms. One of them is definitely the technological innovations which comes under the e-services, and also in terms of the e-banking services that are being seen. For example, the kiosk, particularly for the automated teller machines, which is ATMs, the prevention of the long queue, and thereby the ATMs have come up in a wider use. Next, the prevalence of the fiat money or the plastic money in terms of the smart cards, and definitely the online banking. So this online banking, the e-platforms, and also with the advent of capital market innovations, the Demat account, all these have created an immense effect on the consumers in terms of their flexibility, in terms of their ease and convenience. So in terms of the technological impact on the banks which have come over time, and more after the year 2000, and also as we go by the year 2020 or 2021, despite the impact of the pandemic, we have seen that the e-banking services have been in constant place. And not only that, pandemic has also meant the online operations to be more and more pronounced in the other sectors also, where the online transactions have taken up a bigger shape. So this online banking, online transactions, use of the smart cards, ATMs, have made the customer dealings to be more smoother. And in terms of the bankers, the accounting, the auditing, maintenance of the digilockers, and also the examining functions, supervisory functions, have made it more and more smoother with a good e-governance under the effect of technological innovations. More importantly, in the changing structure of the banks, the role of the banks have changed over time, taking care of the word of competitiveness. Because with the advent of more mergers and acquisitions, with the advent of the private banks along with the public sector banks, the competitive structure of the economy has become more and more dynamic. And this is because the government regulations has been constantly changing. With the Basel norms, with the capital market reforms under the Securities and Exchange Board of India, SEBI, the RBI has come up with a more and more competitive structure between the banks, and it has become more fiercer with the regulations being changed. Banks compete with each other with other businesses that sell financial services. This is very important because bank also offers insurance, as well as insurance are also being provided by the private insurance companies. So whenever the bank offers insurance, we say bank assurance, as well as private insurance parties also are in place. So this is basically one of the challenges the bank has to face at every time, how to make their product more attractive, how to make their product more user-friendly and customer-friendly in the context of financial services. And this is one of the after effects of competitiveness that is within the market-oriented economy of the banking structure. So we thereby invite a question on two important parameters which are explaining the changing structure. Firstly, analyze the effects of technology, because technological innovations have been very dynamic and it's rapidly changing over time, and competition in the banks, because these two are basically interlinking topics. These are two interlinking concepts, because competition through technology and technology through competition is making the banking structure to be more robust and dynamic. So in terms of this, we have the impact on bankers, which can be identified in terms of accounting, auditing, and supervisory functions, and in terms of competition with the others. And also it can be explained with respect to the customers in terms of their convenience and ease of doing banking business. Now we actually explain on the role of banks. So after discussing the changing structure with reference to the modern parameters over time, the role of banks have eventually changed over time, and also it has been in tune with the recent policies. The role of banks can be identified as record keeping, identification, enforcement, transfer security, and sound business practices. In terms of the transferring money or in terms of the transfers that has been done, banks are playing an important role, particularly in transferring money to provide growth and stabilizing the monetary supply. By this we mean that in any nation, the most important criteria of a monetary policy is to ensure price stability. So with the functioning of the banks and with the adoption of the monetary measures, price stability is very important. Transferring money in the sense refers to how the government can be sometimes helped out or accommodated by the expansionary monetary policy, basically to ensure high growth and at the same time ensuring price stability. Stabilizing the monetary supply means in terms of the money market that comes in. Because in the definitions of the money, we have the broad money under the RBI money regulations. So by broad money, we mean the printing of currency, the deposits, the coins, the other denominations, which have to be stable to actually take care of the inflation. Second important point in terms of these functions is lending the money which is actually provided by the banks for the customers, that is the consumers, and the businesses, particularly the firms, who can actually go for future investments which they want to take. So two important dimensions are opened up. One, in terms of transferring money to provide the growth potentials, and secondly, making the money available for the customers or the consumers, and also for the future firm decisions that can take place. Then we have the most important role in terms of between banks. Whenever we refer to between banks, we basically refer to the process of credit creation. Like suppose an individual is investing in bank A and thereby taking out the money from there and depositing in bank B. In this way, bank A, B, C and onwards, all banks are actually joined in a common network, and thereby the banking provisions can be done, or between banks different kind of exercises can be conducted. And finally, the credit creation can be robust in terms of the volume. Banks can also interact with the individual customers or the consumers, and thereafter the consumers can interact, and thereby the bank and consumers can develop a healthy relationship in terms of the service and in terms of the feedback mechanism. Banks also act as a collaborative effort or as a catalyst to promote the industrial growth in terms of different kind of credit availability, in terms of approving different forms of loans for different banking purposes. Banks and government are also in place in terms of a good amalgamation between the monetary policy and the fiscal policy. This is very important for a nation to work on. A fiscal balance has to be supported or has to be financed by the monetary balance. And this calls for a good balance between the banks and the state. And also between one country's government and the others, the bank also acts as a catalytic role in terms of fund transfer or in terms of better economic or any financial relationships. So when we go for the banks in terms of the role, first comes the loans to the business, which basically the business counterparts, to the governments which are taken care of, and also the individuals in terms of the availability of the plastic money, that is the credit cards, providing the loans, that is the home loans, and also the automobile loans that has been taken up as a car loans. So there are many other type of loans also available, but these are some of the examples whereby the changing structure is identified in terms of more and more provision for the automobile loans or the home loans are taken up. Because this is how the urbanization, the changing demand of the demography, and also with the result of influx of more population in the urban areas, the nature of the loans or the demand for the loans have risen. And this is also of the changes in the employment structure of today's economy. So all these reflections are felt within the changing role of the banks over time. Most importantly, when we look at the governance component of the banks, in terms of how the role is changed in terms of a good governance, in terms of the supervisory functions, the first important word that comes in, credit worthiness. that is evaluating the credit worthiness of customers, is a banking function and affects the economy at large. This means that the banking viability, the credibility of the banking structure is very important. So by credibility we mean how the bank can perform the functions efficiently, how the banking functions are transparent and accountable, and how they affect the economy in a larger view. This also takes care of involving more people under the banking sector, and that is what we say by the big word of financial inclusion, like opening up bank accounts for majority of the population as it has been taken up in Indian economy. So this also goes by the JAM project, that is Jan Dhan Yojana, Aadhaar and mobile banking, which makes the credit worthiness of the customers to be in place. Secondly, when we look at the supervisory functions of the banks, we also keep a note on banking policies and regulations, particularly in terms of the loans and the deposits, so that a financial environment can be sustainable and secure, because most of the times the financial environment may erode, and this may give rise to the rise in NPS or non-performing assets. So this can deteriorate the health of the banking structure. So this is also very important to have a secure financial environment. So when we refer to the role of the banks, we mainly refer to the word on transferring, to the lending activities, credit creation process, and also the money multiplier process that are in place for the commercial banks and the central banks taken together. So when we refer to the banking structure and the roles and the changing structure, we also want to measure some new terms that have come up in the banking dictionary. The most important term is net interest income, which in banking words called the spread of the bank. That means the bank pays in interest and what is receives in interest. Basically pays in interest when the deposits done, and the receives in interest when the banks basically loans from the public. So this spread is not the pure profit. The spread can be considered as the revenue, and the left out after the costs are deducted, we get the profit. So thereby we can say that there is a thin line of difference between the money and the funds. So apart from the interest income, banks also have other sources of income. For example, account maintenance fees, for example, ATM transaction fees, all this comes under the fund management of the banks. Banks also make money on investments, that is very important. Also for the stakeholders' investment, banks may have funds at their disposal, and this also takes care of the banking transactions. So when we talk about the rental part, when we talk about the money investment part or the disposal part, all these things comes under the money and the fund changing structure. So thereby we can say that when we refer to the spread of the banks, we say that the difference between what a bank pays in interest and what it receives in interest is called the spread. So that is the difference of the net interest income that is accounted for. Further, in the banking structure, we have another important constraint we can say from the cost benefit analysis is basically the asset that are being generated, and finally what are the liabilities that are coming up. So when we talk about the asset, it's anything of value, which means money. Sometimes this asset can be easily exchangeable, and that is what we say liquid asset, which we say idle cash or the real money balances. Or in other words, we can say an obligation, which is in financial term called liability. So there is a balance sheet of the banks which have to maintain the balance between the asset and the liability to make the functioning better. So when we look after the changing structure of the banks, apart from the role of the banks and how the new parameters are coming in place, we also thereby refer to some of the banking intermediaries or institutions which are in operations. For example, the depository intermediaries and the non-depository intermediaries. Depository intermediaries are those which obtain funds from the public. So any kind of banks funds or any kind of mutual funds which are floated by the bank, they basically comes under depository intermediaries, and these funds are being done to finance their business, which can come up in HDFC or ICICI Prudential or any other mutual funds which are being floated. Apart from that, the non-depository intermediaries do not take or hold deposits, and they earn their money by selling specific services or policies. because any kind of service from corporate social responsibility, from environmental point of view, or any other kind of banking transaction taking place where no under roof or umbrella is there, that comes under non-depository intermediaries. So basically the depository institutions are given in common as commercial banks, which is the largest proportion in the total banking structure in terms of the depository institutions, some saving and loan associations, sometimes there are tax savings bonds also, mutual savings banks, but particularly the mutual institutes or the mutual bankers which are there, and some credit unions are in place which also takes care of the depository institutions. And for non-depository, we have the insurance companies which actually offer services in terms of life and non-life insurance, trust companies, particularly the pension funds which are in place, different brokerage houses which open up different kind of investment products in terms of investment potentials, loan companies which are taking up, and more importantly currency exchanges. All this comes under the umbrella of non-depository institutions. So basically when we come up with the banking and the non-banking institutions, we mention a kind of question on mention the names. So any kind of terms or any kind of examples can be identified here which comes under the category of banking versus non-banking institutions. So basically in this particular module, we define the concept of the bank, which is basically a business unit. The role of the banks can be identified in terms of transfer of funds, in terms of lending, deposits, in terms of supervisory functions of banking governance, in terms of currency management, and other ways how the new parameters can explain the spread of the bank, particularly the effect of technology and also the effect of the customers friendly activities. Moreover, the depository institutions are in place, followed by the banking institutions also taken up. So in this way, the changing structure and the role of the banks over time has become more and more amplified, and it has also taken up a most important domain in the entire economy with the changing dynamics. Thank you.